Explainer 15, productivity. Hi, John Rothfield with Derivative Logic. Simply put, productivity, or more specifically labour productivity, is the difference between the growth rate of gross domestic product and the input of labour. Not the number of employees, but their aggregate hours worked required to produce that gross domestic product. Productivity has tended to shift between regimes. Since World War II, there have been two long periods of strong productivity growth, each averaging almost 3% per annum. The first, from 1947 to the early 1970s, was a product of the post-war boom. Automation, electronics, massive investment in infrastructure, and pent-up consumer and housing demand from the end of the war. The second period of high productivity was from the mid-90s to the mid-2000s. That was the result of further rapid technological change, the peace dividend, the initial impacts of the first round of globalization and outsourcing, and more stable inflation that we'd been used to. There have also been two low productivity regimes, averaging close to half of that, about 1.5% per annum in productivity. From the early 1970s to the mid-1990s, low productivity was driven by oil shocks, various financial crises, and the influx of less experienced post-war boomers into the labour force. The second of these is the secular stagnation period from the housing bubble in 2006 to 2019, and then the initial aftermath of the pandemic. The stasis that resulted from massive government support programs through quantitative easing created this low productivity. Zombification meant there was a subset of companies in the US economy that survived simply because of artificially suppressed interest rates, which overrode their poor interest coverage ratios from their sales. Now, in the last 3 years since the introduction of ChatGPT and what followed, labour productivity averages 2.7%. It remains to be seen whether this will be as long a productivity cycle as the other high productivity periods. Productivity is perhaps the most important measure for an economy. It is a proxy for the steady state rate of growth of the economy. High productivity regimes tend to be associated with higher investable profits and also lower unit labour costs. And in turn, lower unit labour costs map well into lower consumer prices. The Fed cannot make forward-looking monetary policy based on a thesis of strong productivity and low unit labour costs ahead, but its presence makes the trade-off between its dual mandates of jobs and inflation easier to achieve. Please let us know if you have any other topics that we should be covering in our Explainer series.